Hello, folks, and welcome. Thank you for joining us today. I would like to quickly go over some of the functionality of GoToWebinar, because I know some of you may not use this as much as other screen share programs. In the top right-hand corner, you should see this orange arrow. And if you click on that orange arrow, these boxes pop out, and you can control how you're getting your audio. You can toggle full screen or window mode with this button right here, and you can ask us questions. You are all muted. We had over 300 people, almost 400 people sign up for this. So for ambient noise purposes, everyone's muted, but we do want to hear from you. We do want to hear your questions, and we will have a dedicated QA. So you ask questions here, and you can pop the question window into the center of your screen to more easily see it by clicking on this little square right here. Additionally, once we're sharing, you'll see the slideshow and you'll see pictures of us, our cameras. I will hide mine. I am Scott Guile. I am the Executive Marketing Manager for Macmillan. Carolyn Merrill, who is the Senior Executive Program Manager, is also joining us. And you probably see our pictures up here and the slides down here. You can slide this bar where this blue arrow is. So if you want to make our pictures really small, or if you want to make them really big, you slide that bar back and forth. If for whatever reason your screen is not showing, you're not seeing the visual, in your tray you'll see this blue, or if you're on a Mac, an orange flower. If you click on that, it maximizes and minimizes the visual. So if you're not seeing the visual, if you want to pop the visual down, that flower icon will do so. So I'm thrilled to have today Alex Tabarrok, who is the Bartley J. Madden Chair of Economics at the Mercatus Center, Professor of Economics at George Mason. He has published in many, many journals. He is the co-founder, along with Tyler Cowen, of the Marginal Revolution University, Marginal Revolution blog, and the co-author of Modern Principles of Economics, 5th edition from Macmillan. I previously worked with Alex as a marketing manager back in the aughts in 2011. He and Tyler are very innovative. They're always thinking ahead. And he's going to talk today about crypto. We're also going to be publishing an online chapter about this. Not exactly what he's presenting today in the online chapter, but it's the kind of innovative thinking that these guys are so good at. And so without further ado, I'm going to pass things over to Alex and let him take it away.
Awesome. Thank you, Scott. This is going to be a lot of fun because this is a rapidly growing field with a lot of interesting innovations. As Scott mentioned, in the next edition of our book, Tyler and I are going to do a chapter, probably online, on crypto economics. And we're going to talk about cryptography. We're going to talk about, how does Bitcoin actually work? What is an NFT? And also DeFi, decentralized finance. Today, what I'm going to do is slightly different. I'm going to go into more depth onto decentralized finance. The professors should always be at least one step ahead of the students. So we're going to go into a little bit more depth. Okay. First of all, just the rise of DeFi. So the total liquidity available on decentralized exchanges has climbed from about $1 billion circa 2020 and is now $250 billion in just the matter of a year or two. The market volume on decentralized exchanges is also quite large, $2 to $3 billion per day. Now that's small relative to traditional exchanges, which can be in the trillions, but it is growing very rapidly. And indeed, I think this could be a case of what Clayton Christensen has called a disruptive innovation. A disruptive innovation is one which starts out small, crude, sort of even laughable to the big players, but then it explodes, displacing the market leaders almost before they realize what is happening. So indeed, if I were the head of the New York Stock Exchange or NASDAQ or any currency or bond exchange in the world, I would be very worried about DeFi right now and would be looking into it. So let's just have a brief primer on sort of centralized finance versus decentralized finance, and then we'll get more into DeFi. So centralized finance, not too surprisingly, uses centralized exchanges. And that means that a trader, they have to give up custody of their dollars, their tokens, their coins to a intermediary. This is so sort of normal, we don't even think about it. But actually what's going on when you want to trade on the New York Stock Exchange is first you need an account with like Ameritrade. You can't even get an account directly with the New York Stock Exchange. And you have to take your money from your bank, put it into your Ameritrade account, and give them custody. So that requires a lot of legal documents because you are giving up custody over your funds. And then Ameritrade will trade on your behalf on the New York Stock Exchange. Indeed, most people don't know this. Someone surprised to know this, but legally, when you're like buying stocks from the New York Stock Exchange, you don't actually own them. The depository trust company technically owns all of the stocks. Like 99% of the stock on these exchanges is owned by one trust company. With a centralized exchange, this means you can also be censored by the intermediary. Censored not in the sense of free speech, but in the sense that the intermediary could say, no, you can't trade, or no, we're closed, or they could potentially abscond with your funds, or your funds could be hacked, something like that. On a decentralized exchange, the traders keep custody of their dollars, their tokens, their coins, and they trade directly without an intermediary. This is more censorship resistant. Now, I just say resistant because it's not censorship proof. You know, there's always kind of bottlenecks and places where there can be more potential censorship, and regulation is also kind of bringing decentralized finance somewhat closer to centralized finance, but let's say it's more censorship resistant. In centralized finance, in addition to the legal documents that you need to give up custody of your funds, you may also have to satisfy know your customer regulations and identification, anti-money laundering rules. You may even have to prove your net worth or how smart you are to satisfy accredited investor rules. So in the United States, the government says literally, if you're too poor or you're not smart enough, you cannot invest in certain assets. Decentralized finance, no identification necessary. Most of the trading which goes on is anonymous or pseudo-anonymous. And it's open to everyone in the world with a cell phone. Centralized finance, all these rules are sort of nation-based. Decentralized finance, open to the world. Centralized finance also uses order books, which I'm going to talk about briefly, while decentralized finance uses automated market makers. And automated market makers, in fact, is going to be the bulk of my discussion today. One point which is just worth footnoting is that there are centralized exchanges also for crypto. So if you're trading Bitcoin on Coinbase, you're not decentralized, you're not DeFi. So crypto can be on a centralized exchange as well, like Coinbase. That's not DeFi. So DeFi is different than sort of just crypto. Okay, so let's look at traditional finance and order books. Okay, so in an order book, the buyers post bids indicating the price and quantity at which they're willing to buy, and the sellers post asks indicating the price and quantity that they're willing to sell. And when a bid exceeds an ask, then there's a sale. And there's actually a variety of different types of orders: limit orders, market orders, stop loss orders, and there's a bunch of different rules for determining which orders are executed first and at what price. So order books can be quite sophisticated, and order books have been in use, for hundreds of years. It's not easy, however, to run an order book on a decentralized blockchain. So initially, in the blockchain world, people tried to replicate what goes on in centralized finance, but there are some problems because blockchains actually tend to be pretty slow, and they're expensive to use. So it's expensive to run a sophisticated order book on a blockchain. So instead of order books on centralized exchanges, DeFi has moved towards automated market makers, AMMs, on decentralized exchanges. And an AMM is a smart contract that offers to buy and sell at a price given by a predefined formula. AMMs actually go back to an idea which Robin Hanson, one of my colleagues, developed for prediction markets. And then there were some suggestions on Reddit, okay, from Vitalik Buterin and Martin Koppelman in 2016. Using these ideas, the first big decentralized exchange, which was Uniswap, launched in late 2018, and it pioneered the use of these AMMs. And these AMMs, they're now used to buy and sell billions of dollars worth of crypto assets daily. So, what is an AMM? Now, I'm going to explain it. I'm going to explain the constant product automated market makers, which is the simplest type. And as I explain it, you're going to think, that's stupid, right? That's ridiculous. That's absurd. How could that possibly work? Okay. So indeed, that's what I thought when I first saw these things. So don't be too surprised if, as I'm speaking, you're thinking that doesn't make any sense. I promise you, it does actually. Eventually, it will make sense. So hold on to your thought. Don't give up on me while you think that. So here's a constant product AMM for assets X and Y with reserves RX and RY. It's just a curve. It's a curve such that RX times RY is equal to C, where C is a constant. Okay? And this AMM, it's going to be instantiated by a smart contract. And it works in the following way. Anyone who sends delta Y to the contract receives delta X, where delta X is just what is necessary to satisfy this equation, so that you're on the curve. Okay? So let's give a simple example. Suppose we have reserves of Rx of 10 and Ry of 10. So Rx times Ry equal to a constant is 100. What this automated market maker says is that you can trade anywhere along this curve. So long as you start on the curve, you end on the curve. So if we start at 10.10, then for example, you could send 10 to the smart contract and you can receive 5 in return. Any trade is possible so long as you start and end up on the curve, right? So this curve starts at 10.10, which is 100, and then you can also be up here, 25, which is also 100, so it satisfies our equation. Let's just focus on this for a moment and explain the implicit prices, which are inherent in the AMM. So for example, if I were to send 2 to the smart contract, I will receive 2y to the smart contract. I will receive in return 5 over 3x. And the reason for that is because 10 minus 5 over 3 times 10 plus 2 is equal to 100. If you then think about, well, what was the implicit price of x? That's delta y over delta x. So that's 2 over 5 over 3. So I paid 1.2 y per x. If instead I sent 1 to the smart contract, 1y, I will receive 10 over 11x, and the price is 1.1. If I sent just 1/10 of a y, I will receive just less than 1/10 of an x, and the price of the x then is 1.01. So you notice that the price of x is approaching 1 as delta y is getting smaller. And that's in fact not an accident, okay? Remembering that Rx times Ry is equal to C, and just then writing then Ry is equal to C over Rx, okay? Take the derivative, right? So R prime of y is equal to C over R squared of x. Then you just remember that that C is equal to Rx times Ry. So just substitute that in for C. What we find is that derivative of y is equal to Ry over Rx. And all that means is the marginal price of x in terms of y, which is R prime of y, derivative of R, delta y over delta x, is Ry over Rx. And then remember in our previous slide, Rx and Ry were equal to 10, so Ry over Rx is 1. So the price approaches 1 as the trades get infinitesimally small. Okay, so on this kind of constant product market maker, the implicit price is RY over RX, the reserves, the Y reserve over the RX reserve. Okay. Now, here, now you're by now wondering, what is the point? What is the point of a price computed by a function and not by supply and demand, right? I'm supposed to be a free market economist, right? And so now here I'm telling you, oh, there's this fantastic innovation in DeFi where we don't use supply and demand to find the price. Instead, we use this function. What is going on? The answer is arbitrage. The answer is arbitrage. Arbitrage keeps the AMM prices close to market prices. And here, close is going to depend on the fees for the AMM, which I haven't discussed yet, but I'll mention those in a minute, and also on how liquid the true or the reference market is. Also, it might be a little odd to have a AMM and assume that there's another market with a market price, because the AMM may be where the majority of price is determined. So the market price may exist only in the minds of market participants. Okay. Nevertheless, the point is that there are profits to be made from trading with an AMM to bring it closer to the true or market price. Now, there's also something else very interesting here. I'm supposed to have a flash, but I think I think the animations on my PowerPoint are not coming through. But let me explain the flash. There's an amazing thing in the DeFi world, which is what is called a flash loan. Now, with a flash loan, anybody in the world can borrow millions of dollars without any collateral or any identification. I mean, it sounds incredible. It sounds impossible, but this is actually true. Now, you can't borrow the money to buy a Lamborghini, but you can borrow the money to do very specific kinds of things, including arbitrage. And here's how and why it works. With a flash loan, you write a transaction where the money is borrowed, you make the arbitrage, and then the loan is repaid with interest, and that entire transaction is bundled together so that if any one part of the transaction doesn't work, nothing works. So if the money isn't paid back, it's as if the money was never borrowed. So that's called an atomic transaction. It's all together or nothing. So you can borrow millions of dollars, do an arbitrage, pay it all back in one transaction, and anybody in the world can do this. And that's part of what makes arbitrage so powerful in decentralized finance. Let's say a little bit more about this with an example. So again, we're just going to assume our typical case that Rx times Ry is equal to 100. And we're going to start with the price of X of 1, and we're going to fix the price of Y at 1 as the numeraire. That is, only relative prices matter. So we'll just think about Y as just fixed at 1 and think about the price of X changing. So we're going to begin in equilibrium, okay? And now suppose that X becomes more valuable and it rises in price from 1 to 4 in the market. But on the AMM, the price of X is still 1. So arbitrageurs, therefore, they'll want to send Y to the smart contract in return for X until the marginal price is 4. So formally, we want to look for a situation where Rx times Ry is equal to 100, so we're still on the curve, but Ry over Rx is equal to 4, so the price is 4, and we want to find a situation where that is true. And of course, if you solve that, you'll find that the solution is 20 and 5. 20 times 5 is 100, 20 over 5 is 4. So what's going on here? Well, as I said, when the reference price goes from 1 to 4, arbitrageurs send Y, they're going to send 10Y to the smart contract in return for 5X until the marginal price is 4. So you begin, the old equilibrium is here at 1010, the new equilibrium is here at 520. Now notice that the arbitrageurs, they made money because they paid $10, 10Y, for 5X. They sent 10Y to the contract, they got 5X back. But the 5X at a price of 4 is worth 20. So they sent 10, they got $20 back. So they made money on this deal, right? So just repeating, the arbitrageurs paid $10 for 5X worth 20 for a profit of 10. Now think about this from the point of view of the portfolio, which the reserves or the portfolio, which the AMM started out with. So it started out with a portfolio of 10X and 10Y, which had values of 40 and 10, or a portfolio value of 50. After trading, the AMM has a portfolio of 5X and 20Y, which is now worth 20 and 20, or a portfolio value of 40. So the AMM lost $10. Not too surprisingly, the arbitrageur's profit equals the AMM's loss. Equivalently, if the liquidity providers backing the AMM, and I'm going to say more about the liquidity providers, but they're the people providing the reserves, the RX and the RY. If the liquidity providers backing the AMM had held on to their coins, then their portfolio would be worth $50 instead of $40. So the liquidity providers had an opportunity cost of $10. If they'd held on to their coins, they'd have 50, instead they only have 40, so they had an opportunity cost of $10. Now in the DeFi literature, the losses to the liquidity providers, they're called impermanent loss. This is a terrible name, just an awful, awful name. Sort of the idea that they wanted to sell was that, well, if the prices revert to their previous values, you get it back, you get an impermanent gain, right? Anyway, that's in the literature, so I mention it so that you understand what people are talking about when they mention impermanent loss. It's really simply the fact that there's an opportunity cost to the liquidity providers, which is also what the arbitrageurs, the profits of the arbitrageurs. So the profits of the arbitrageurs equals the opportunity cost of the liquidity providers equals impermanent loss, all the same thing. Now, why is there this loss? Okay, it's because the AMM is always trading at an information disadvantage. Now, in the stock market, prices can change with no trade. So if the buyers and sellers hear good news at the same time, the price will jump up with no trade. And if they hear bad news, the price jumps down with no trade. So in the stock market, prices can move about without any trade actually happening. On an AMM, the price can only move with trade, can only move with trade. So the AMM smart contract is actually kind of dumb, right, in a sense, because it's always trading at an information disadvantage. So then you might ask, well, why then would anyone ever be a liquidity provider? Why would they back an AMM with the reserves? And the answer to that is that liquidity providers get transaction fees. Okay? They're going to earn a little bit for every transaction. So the pure AMM, which is what I've been talking about, is just this. Actual AMMs impose a transaction fee, okay? So that RX minus delta X, so that basically to receive delta X, the trader must send fee delta Y. I thought I was very clever with my use of Greek symbols there. So they have to send this fee delta Y with the fee big greater than 1. And the trading fee is used to pay gas, which is compute power on the blockchain, and also to reward the liquidity providers. So what the liquidity providers do is they stake or they provide equal value amounts of each token, and then they receive LP tokens in return. And the LP tokens are just a way of computing how much of the fee goes to each person. So there's 1,000 LP tokens, and you own 100 of the LP tokens, you get 10% of the fees, which are going to the liquidity providers. Okay. Also, very early on, liquidity providers are typically also subsidized with some token inflation to prime the pump. So it's been very profitable in the past year or two to get in on some of these markets early, because in addition to the fees, you're being subsidized as well. Sort of like Uber started out with really low fees, really low prices to attract drivers and riders and so forth. Same kind of thing has been going on in DeFi. So if we think about this, that the liquidity providers earn when there's lots of trades around the current price. So, you back and forth, back and forth, back and forth around the current price, back and forth. That's what the liquidity providers really want. If that is happening, that the price is just going back and forth, then they're not suffering any opportunity costs or impermanent loss on their tokens. It's when the AMM price departs from the market price, then the arbitrageurs exploit the AMM and the liquidity providers bear an opportunity cost. So a key issue is thus how quickly the AMM price moves away from the market price with a trade. And in the DeFi world, this is called slippage. When the price moves a lot, when there's a lot of slippage, that provides free profits for the arbitrageurs. So what an AMM wants to do, it wants to reduce slippage to attract traders and also liquidity providers. So an AMM must do both of these things. It must attract traders and liquidity providers. So attracting liquidity providers is important because the more liquidity, the larger the trade that can be made at a price near the marginal price, the larger the trade that can be made with very little slippage. So if you have RXRY is equal to 100, as I was showing you before, then you need to pay 1.1Y to get 1X. That's what I showed you earlier. If instead there was more liquidity provided, instead of 1010, you had 3030, so RX times RY is equal to 900, then you only need 1.03Y to get 1X, okay? So if you're on this curve, Rx times Ry is equal to 900, okay? The curvature of the curve is less, so you could make a larger trade at a lower price, or you could make the same trade at a lower price, right? So Rx times Ry has a smaller curvature at the same point. Rx times Ry is equal to 900 has a smaller curvature at the same point than Rx times Ry equal to 100. So the AMM wants to attract a lot of liquidity providers so that you can have low fees for the traders, less slippage. Also, if you have lots of liquidity on the AMM, then it's going to be harder to manipulate. Okay, it's going to take more arbitrage to manipulate it. Another key issue then is to increase capital efficiency. Okay, so we saw that the more liquidity provided, the less slippage, the closer you get actual trades to the marginal price. You can also do the same thing by making your capital, using your capital more efficiently. Okay? Now, here's one way of doing it. There's an advantage of the very simple Rx times Ry equals C curve, is that in a sense, it never stops working, because as long as there's some reserves, a buyer or seller can always trade with this AMM. They're just going to have to pay very high prices, but so long as there's some reserves, they're always going to be able to make a trade. The disadvantage is that the reserves are locked for low probability events. So let me give you an example. Suppose we start with, again, Rx is equal to 10, Ry is equal to 10, and suppose that we think that prices, they're unlikely to depart from a ratio of 4 to 1. Well, in that case, we would at most expect reserves to vary between 5 and 20 or 20 and 5, right? Now, that means that that $5 is sort of wasted capital. It's locked in the contract, but it's never used, right? because you're going in between 5 and 20 and 20 and 5. You never sort of use that 5. Okay. So here's what Uniswap 3 does, which is Uniswap is only like 2018, and we've got a Uniswap 3 already, so you can see lots of evolution in this space. Uniswap 3's method of improving capital efficiency is to allow liquidity to be concentrated on a region. So this modifies the equation, but you can modify this Rx times Ry equal 100 equation to have the same slope, but use about half the capital. Okay, so it kind of shifts this curve in. So the curve has the same slope. This curve actually, as I said, has the same slope as the curve of Rx times Ry is equal to 100, but it uses the same capital as Rx times Ry is equal to 25. The reason it can do that, okay, you get reduced slippage. The reason it can do that is that if you reach a point like this, there's no more reserves, then you're kaput. You can't trade anymore, right? So at these 2 points, that's when the reserves are depleted, okay? Now, so on something like Uniswap 3, people can place their reserves in different regions, okay? They can adjust, overlap. So typically that's not a problem. They have plenty of reserves, so they're not going to run out. But the idea here is to improve capital efficiency, reduce slippage, offer better trades using the same amount of capital, offer trades closer to the marginal price. Here's another way this has been done. This is Curve, which was started by a mathematician. Remember that the informed traders can profit by trading against the dumb smart contract, okay? If an AMM could specialize in uninformed traders, then it could offer lower fees. You might wonder, well, how is that possible? But there's ways of doing it. For example, there are stable coins, which are coins designed to trade at a price of 1 for $1. Okay, they're designed to have a fixed price of $1. Either they have reserves or they're algorithmically programmed to keep the price of the coin close to $1. Okay. Well, if you have, and these are very useful in DeFi, okay, because if you're moving coins around, you don't want to have a coin which can change in value quite a bit, like Bitcoin. So if you could focus a market where people want to trade one stable coin for another stable coin, then the trade is probably uninformed. Okay, both coins should trade at $1, and most of these trades are done for convenience rather than for speculation. So it's probably not the case that somebody has some inside information that one of these stable coins is about to bust. That maybe happens sometimes, but pretty rarely. Most of the time, you're just trading one stable coin for another for convenience. So these two trades are probably uninformed. So what Curve does, it specializes in stable coins, and it offers a lower curvature function, less slippage than a constant product AMM. And as a result, it can offer lower fees and better prices to traders. So this idea of increasing capital efficiency, that's been a big driver of improvement and innovation in these DeFi spaces. Okay. Let's talk about a couple more cool advantages of these AMMs. A big one is what is called composability. Okay? And that is that smart contracts like AMMs, but other smart contracts as well, they can, once they're deployed on a blockchain, anybody can use them. So one smart contract can in fact feed into another smart contract. So you can combine these smart contracts like Legos to produce very sophisticated financial products and other products. Very simple example, if we have a dollar to Bitcoin AMM and we have a Bitcoin to eGold AMM, then by sequential trade, which can all be handled with one smart contract, we have an eGold AMM. And that's just a simple example, but there's lots of other examples like creating mutual funds using smart contracts. looking across all of the potential places to lend money and using a smart contract to send your funds very quickly from one lender to another in order to find the highest interest rate. So you can build these things. And code uploaded to a blockchain never goes away. So each new smart contract adds to the potential capabilities of every other smart contract. So we have a potential here for composability plus combinatorics equals explosive innovation. So there's a potential here, since things can be reused and put together in all these different ways, that this can be a very innovative and fast-moving field. Okay, so some of the advantages of AMMs, just to recap. Let's go back to order books for a moment. Order books require thick markets. And that's one reason that markets like the New York Stock Exchange, they're only open from like 9:30 a.m. to 4 p.m. daily. They're not open on the weekends. They're not open on holidays. Why? Well, one reason is because you want to concentrate your traders in one relatively short time frame so that you get the advantage of a thick market. AMMs, in contrast, they're available 24 hours a day, 365 days a year from anywhere in the world. Of course, at the disadvantage that they're always vulnerable to better informed traders who arbitrage against the AMM. But still, that's open all day is a pretty sophisticated, is a pretty useful capability. AMMs can be instantiated with smart contracts. They don't require giving up account custody, so they can work well with anonymous buyers and sellers. And that's most of what happens in DeFi. Anyone can build and deploy an AMM. So we have a situation in which every few months, there's like a new New York Stock Exchange, right? So first AMM, about 2018, Uniswap, but now Uniswap, we have now version 3, we have Curve, we have Bancor, we have Meyer. We've got all of this competition as people are entering the market to create a new exchange. NASDAQ was like the first new exchange in I don't know how long. It's pretty hard to create a new exchange in centralized finance, relatively easy in decentralized finance. AMMs are composable, and that's potentially going to lead to a lot of innovation, all of these things. So let me conclude. Marc Andreessen, who you just take a look and you say, hey, man, that's the smartest guy in the world, right? Marc Andreessen has argued that software is eating the world. Okay? And blockchains and smart contracts, that's software. Software that could potentially reduce transactions costs in payments, in borrowing and lending, buying and selling securities and so forth. And thus, these things can have a big effect on money, banking, and finance. Most assets, stocks, bonds, real estate, I think will move online and will become to be represented by a token or a coin. And it'll be traded on blockchains using an AMM or something like that. This is sometimes called the tokenization of everything. I think that's the world towards which we are moving. AMMs and flash loans are just two very recent innovations in this field. I think we're in the creative destruction period of DeFi evolution. A lot is changing and it's happening very quickly. So you want to pay close attention to these markets as they are indeed changing very quickly. Thank you very much.
Thank you, Alex.
So I think our sponsor is going to have a few words, and then he'll turn it back over to me, and we will have time for Q&A. And I think I will try, if you put the Q&A, put the questions in the chat, I will try and look at those.
Absolutely.
Get prepared.
Thank you, Alex. This is Scott again. And yes, I will moderate the questions. We've already got a few that came in. If people have additional questions, please ask them. Macmillan is the sponsor of this, and we publish Modern Principles of Economics from Alex Tabarrok and Tyler Cowen. It is available in Achieve. This is the Achieve system. It is a courseware system that allows you to manage your course, but it's also got thousands of preloaded resource assessments, adaptive quizzing, a gradebook, reports, the full ebook. Alex and Tyler are writing a crypto chapter for upload in the fall to this system. It won't be at the level of the presentation you just saw, as Alex alluded to at the outset. It will be more directed at students. So it's something that you could have as a resource for your students if you have access to Achieve. I don't want to get into the demoing of Achieve here. I'll quickly take a look at what's in one chapter. As I mentioned, there are pre-built assessments, 3 of them in each chapter. There is an adaptive quiz in each chapter. There's the ebook in each chapter. In addition, there are 170 marginal revolution videos in here done by Tyler and Alex, which are really great concept videos that have accompanying questions. If you want access to this, I'm going to put up a screen as we do Q&A with my email address, and you can request access from me. And with that, I will get into the questions that we have, and I see another one has come in. I'm going to take them in the order that we got them, just for be as fair as possible. Okay, let me get to the top here. Someone asked about a recording, and yes, there is absolutely going to be a recording. The first question we got was, Delta Y, can you define the terms more? And you might have gotten to that because that was kind of an early on question. I don't know if you feel like that could be answered kind of quickly here, but that was asked about 10 minutes into the presentation.
Right. So basically, I was just thinking that delta Y being positive. So you send something, you can't send negative values. So you can send some, you can send either Y or X, whatever you want, to the contract, and then you're going to get back, okay, the other coin which is being traded, okay, according to that function. Now, can I see the chat? What do I need to see the chat? I only see that one question, Scott.
If you click on questions and hit that little square, it will pop out. Okay. I mean, the next question that we got, again, I can moderate these if you'd like. The next question that we had gotten was, can you explain more about the asymmetrical liquidity pools like Balancer? What are the benefits to asymmetrical liquidity?
Right, yeah. So Balancer is pretty funny because Balancer is Cobb Douglas, right? So I think most of the attendees will be familiar with the Cobb Douglas production function. And Balancer is just that. So it just allows, again, it allows a way of increasing capital efficiency, particularly if you think that prices are going to move more in one direction than in another direction. So it generalizes things. I think actually it'd be pretty neat to do a AMM with a CES production or utility function. I don't think anyone has done that yet, but maybe that's worth billions. Curve is just again, it's just a different formula for that curve, for the curve at which you trade on. So figuring out what kind of curve offers you the least slippage but can still attract liquidity providers given the types of assets which are going to be traded is like a key thing where you could, you know, have a big innovation and make a lot of money figuring that out.
Okay, the next question, we actually got a bunch at 141, so I'll go with the top one here. Could this possibly lower transactions costs for remittances to developing countries?
Right, yeah, good question. Here's the big defect of DeFi, and indeed of crypto more generally. It's that so far, it's mostly used for speculation and trading one crypto asset for another crypto asset, right? So I think what we're seeing now is like practice. It's practice for when we will have the tokenization of stocks, and you'll be trading stocks on an AMM, and that will indeed reduce transactions cost. there are some crypto companies, crypto platforms, which are working on the remittance issue and also on the lending issue. So, like, an interesting thing about in the developing world, interest rates are much, much higher than in the developed world. You know, you can put your money in a bank here and, you know, you're going to get like 0.1% of interest, right? Virtually nothing. Meanwhile, in the developing world, people are borrowing at 50%, you know, or even higher interest rates, and they are repaying. So if we could find a way of reducing transactions cost, either on the lending side, okay, or on the borrowing side, then we could bring the, you know, developed world and the developing world, or different parts of the world where interest rates are very, very different. We could bring them much closer together, and that indeed would be a big increase in the gains from trade. We're not quite there yet. I mean, it is difficult to, basically, you are trying to use software to replace lending officers at banks, and there's a lot of tacit knowledge. But, you know, it has been done elsewhere. It has been done, you know, you can get a even a mortgage now, standard mortgage, just by dealing with computers. So that's the goal, is to bring that kind of technology, perhaps using artificial intelligence, perhaps using crypto, to bring low interest rate and high interest rate parts of the world together.
Thank you. Next question. Do you think there is any sort of intrinsic value to cryptocurrencies?
Intrinsic value. I mean, there's no, you know, intrinsic value, I suppose, to fiat currencies, to dollars, you know, unless you like the picture, you know, that pyramid. That's a pretty cool picture. It's like an NFT in that respect. Oh, I got this thing with a nice picture on it. What I think they do is they reduce transactions costs. And, you know, finance is a huge portion of the economy. It's something like 8% of GDP. So if you can reduce transactions costs, not only does that mean you can save by doing what we're doing now, but at lower cost, but it also opens up to a whole other area of things that you could do, which you could not do before, such as, you know, make loans to developing countries. You know, we just don't have, the transactions costs right now are just too high for a person in the street. You know, even when you go to the bank, you know, your bank is only making local loans, or perhaps putting in the money in treasuries. The transactions cost so far to reaching people in other countries has been too high. But with crypto, I think that it does become possible.
Okay, next question. We actually have two at 1:44. I'll take the top one. As financial markets develop in this way, how do you see university finance majors and jobs changing, and jobs in the financial industry changing?
Yeah. So I think anybody going into finance has got to learn something about crypto. I think basically it should be part of everybody's portfolio, like not a large part, you know, and I'm not saying go out and, you know, put your life savings into Bitcoin. Don't do that. But it's becoming a pretty substantial asset class, you know, like art, or like real estate, or, you know, stocks or international stocks. You know, for reasons of portfolio diversification, I think it makes sense to have some money in crypto. Again, not a huge portion at this stage, but to have some money in crypto, I think, is a pretty good idea. And yeah, anybody in finance ought to be pretty familiar with this stuff, because it's a huge threat. It's a huge threat to the traditional ways of doing things. So you need to be ready to move quickly when these guys come knocking at your door and you least expect it.
I actually skipped over one of our earlier questions, so I want to return to it. Popular media makes it seem like DeFi is mostly used for illegal activity, but are there estimates of how much of DeFi transactions might be for illegal activity?
Not really, that I know of off the top of my head. I can tell you this: the US dollar is used for way more illegal activity than Bitcoin is, or, you know, just look at you look at the US money supply, like M1, and a huge portion of the US money supply is in $100 bills. Now, you know, I rarely ever see a $100 bill. I rarely use $100 bills, probably like most of you, I don't use them very much. So why is a huge portion of the U.S. money supply in $100 bills? Well, because they're used for illegal activities, but also in countries where there's a lot of financial repression and inflation. The U.S. dollar is a steady source of value. So the U.S. dollar paper money is used for not just illegal activities, but well, they might be illegal in their country, like in Venezuela, but it's used for all kinds of activities outside of the United States, even more than crypto.
Thank you. I'm just trying to we have so many questions here. I don't think we're going to be able to get to them all. What is the impact on the future of monetary policy?
Yeah, that's a very good question. I think it's totally unknown. And I think economists ought to look at this more. Very few economists have paid much attention to crypto at this stage. Hayek early on talked about the denationalization of money, and we do have periods in the United States of free banking where there were competing monies, all backed by gold typically, but they were competing monies put out by banks. So we have some historical things to draw upon, but the theory here, I think, is sort of unknown, and people are worried about that, or the Fed is worried about that. I don't think we yet know.
Okay, if reducing transaction costs is a primary benefit, then isn't it better to develop a programmable CBDC rather than rely on decentralized technology?
Right. Yeah, so a CBDC, central bank digital currency, this worries me because I think the questioner is right. It would be extremely convenient, okay? So you could do a lot of things. The government could do a lot of things, but also I think the public would be very happy, actually. Most of the public would be very happy with a CBDC that they could rely upon and that they found trustworthy. However, what that also means is that the US Treasury would have their eyes on every single transaction in the entire United States and really in the entire world, right? So it would be just like that pyramid with the eye. The eye would be looking at you all of the time. We just saw in Canada that the government froze some people's bank accounts because they were donors to something they didn't like. So I find that quite worrying that we would lose privacy essentially. Okay, essentially there would be no privacy because every single transaction would be recorded on the great blockchain, which would be held by the US government. So I think there would be some advantages. It would be convenient. It would be trusted by a lot of people, but it comes with such negative disadvantages. Again, think what China would do or is doing, right? With the way that the Chinese government is monitoring their citizens with cameras everywhere. And they already have a tremendous amount of eyes on financial transactions. This would raise that to a whole new quantum level.
Thank you. And selfishly, I'm going to read this one and show you guys something really quick. And thank you for this comment. I am already using Achieve in all those videos. They're amazing videos. I'm going to quickly just show you. This is Achieve again. These are the videos that Alex and Tyler have done for those of the who are instructors out there. They're actually Marginal Revolution University videos with embedded questions throughout and assignable to students. So these are actually really, really good. Not about crypto, although I'm guessing might do some in a future version. But I will also share again how to get access to that and return to our crypto questions because we do have no shortage of those. But thank you for the plug for Achieve. That was not a plant. You mentioned regulation. What kind of regulation can come about without entrepreneurs evading those regulated exchanges?
Yeah. So when the internet first took off, right? People said information wants to be free, and this end of censorship, and you'll be able to do things online that you can't do, and most of that just didn't come to pass, right? So there was a little bit of internet gambling, at the beginning, and then the government shut that down, right? There were even guys in Costa Rica, and the government, picked them up when they tried to travel, right? So the problem with crypto from that point of view, crypto is great until you actually want to pay your mortgage. And then you have to find some way of getting from crypto, into standard bank accounts with know your customer, anti-money laundering rules, and so forth. And so there are all these entry points. You can put up checkpoints. You can make the entry points checkpoints, essentially. So in theory, yes, you can do a lot of things without the government, evading government regulation. But if you want to live in the United States, if you want to travel about the world, if you want to get your money into the banking system so that you can pay your mortgage or your taxes, that doesn't really work. It doesn't really work. So we have to find a way of getting some of the advantages of crypto, including privacy and low transactions cost and availability 24 hours a day, and using software and smart contracts instead of expensive people. So we want to get the advantages of those, but make it regulated enough so that people who use this stuff can still, can still put it into their bank, right? It's like another example is, many states have legalized marijuana or medical marijuana, but because the banks are federally regulated, they can't use the banks. So these guys are being forced to, ride around like they're in Somalia with guys with AK machine guns to protect their cash, their little cash. It's not very convenient. It doesn't work very well. Most people don't want to do that. Most people, before we get billions of people into crypto, and we are early, as people in crypto say, we're early. But to get billions of people into crypto, you've got to make it, you got to normalize it. And billions of people are not going to be evading government regulations.
This is probably our last question, because we do shut down at 2. So thank you everyone for your time today, and we did not get to all these questions, which it does not surprise me given the topic and the presenter. So thank you, Alex, and thank you everyone that came. So last question that we're going to have time for: why do you think that AMMs will eventually displace centralized finance when we see that most trading in crypto is done on centralized exchanges such as Coinbase, Binance, etc.?
Right. So if you look at the growth rate, I mean, that is true that a lot of trading is on Coinbase, though in literally the last couple of months, the trading on Uniswap has exceeded the trading on Coinbase. So if you look at the growth rates, again, you can project a fast growth rate into the future and get a very misleading, but the room to grow, I think, is tremendous. And the innovation has not stopped, right? That's the other thing. The innovation in this space has only just begun. So to see how quickly we have gone from some ideas on Reddit to trading billions of dollars, I think it would be a mistake to underestimate how much growth still remains.
Thank you so much, Alex. Thank you, everyone, again. If you do want access to Achieve and you don't have access to Achieve, this is my email. I will get back to you quickly. Make sure that you have access to that. That is for Alex and Tyler's book. It's got the ebook. It's got a ton of resources. Even if you're not using the book right now, it's got a lot of resources for you to use for class. We'll be sending this recording to everyone that came. I hope you guys enjoyed this, or I hope everyone enjoyed this, and we'll be having future webinars on many, many topics, and we hope to see you there. Have a great day, everyone.
Thank you, everybody.
Thank you. Bye, Alex.
Bye-bye.